To be sure it's working. So just testing the mic. Just testing the mic. Just testing. Want to see if the mic is working. Good. Well, good afternoon, everyone. This is Chris Brecher with the Chart Patterns Mastery Room. What is today about? Talking about zones. Now, I've did a chart pattern class for bull flags, bear flags, and Brecher ledges. And most of the zones I show are consolidation patterns, but I'm going to show you both types. But the basics, we have to go over the basics because to trade these kind of zones, you have to have a couple of indicators at the minimum to use. So that's the first thing I wanted to go over. So the first thing is this. So I use it just to start. So I don't want to make your heads blow up with too many indicators at the moment. So all you need is the ATR trailing stop, I think, or a moving average. So this is a 1 minute chart. So let's just go put an hourly on here so you have an idea what we're talking about. Is ATR trailing stop is sort of helps with trend. You can use a moving average. I prefer the ATR trailing stop. If you want to know my settings, there are my settings. 9 period, average true range around 3. That's it. So all this does is give me sort of an indication where I should get in or out. So, and I'll show you what we're talking about in a minute. Next thing is oscillator. So I use the MACD at 310.16. I didn't draw that great. It looks like I had mimosas for lunch, but no. 310.16 MACD. The only reason I show that is when I show a zone, if something is at the top of a zone and it's overbought, I want to see the MACD recycle near zero so it has enough ammunition to plow up or to plow down. So the first thing I want to show you when it comes to channel and any kind of zones is basically a bull flag is a zone. So if you go into this is Broadcom today. And on the right, I'm going to show Broadcom on a tiny chart. So here's a tiny chart for you. This is a zone. Now, the biggest zones I see are after a previous move, up or down. So just previous move, up or down. And so this is what I'm watching in Broadcom. All I'm doing in here is watching this. I'm watching that. Yep, that's a zone. Right there's a zone. So all I'm doing in here is I'm establishing a zone. I think you could see a mile away what's going on the right. So you see the red line at the bottom and you see the support. That's why it stopped there. You see the red line up here and you see that it stopped at resistance. That's all you're looking at a channel like this. Now, what's the probability of which way it's going to break? The probability is if the previous move was a big old reversal candle like you see here, and then it consolidates under resistance and doesn't have a lot of support underneath, like you see in here, then the probability is this channel or zone is more likely to break to the downside. So I'm really into support and resistance. So here's the three things I think are the most important. Like the ATR trailing stop, like I mentioned, the oscillator, and support and resistance. Now, the easiest way to look at support and resistance is the more times something touches, the more important. And right now, the free room just joined. So welcome the free room. So welcome to the free room. Right now, I'm dual broadcasting just to let you know, and I jumped on early. So just to test everything. But right now, what we're going over is how to establish zones. So there are three things that are the most important factors with zones. One of them is the MACD to determine overbought or oversold, the probability of a zone breaking up or down. Number two is using something like an ATR trailing stop. So I'm using the ATR trailing stop right here. Those are my numbers. Just went to ATR trailing stop on Thinkorswim and added 9 and 2.9. All you're doing in here is you don't want to initiate if the trend is against you of trying to do the opposite. So it keeps you on the correct side of the market, even if you miss things. And three is support and resistance. So the more times that a price is touched, the more just formidable, that's about the longest word I've ever used, more formidable a resistance. So definitely those are the three basics of what I use. When I look at support and resistance, the more times a trend line can touch, the more important. That's a good resistance right there. So that's one way to look at a zone. The next reason is what was the previous move? So if the previous move is a nasty reversal candle and then it consolidates, like I did in my chart patterns class about bull, bear, and Brecher ledges, this is more likely to break down because it's a consolidation pattern. Also, you don't have a lot of schmutz underneath. So the path is more defined on the way down. So you see this. I'm going to make it a big old arrow for you. There, you see the lack of support. You see the resistance up here. Now, there are a lot of other factors, but that was a zone. So if it broke up, well, probably wouldn't touch it. And that's why you have to look at different time frames. I just can't stress that enough. So when you go to a 15-minute chart, what's it look like? Well, it's not that overbought nor oversold. That's what we want. We don't want it extremely oversold because then the probability of this going all the way down to here is less likely. It's all about probability. So the first thing when I determine a zone, if I'm day trading, is to look for those kind of bounce around right in here. Now, there are a couple of ways to trade this then. Like I said, the likelihood that this is a consolidation to the downside is more probable than just an amazing reversal. I'm just going on probabilities. Now, there is a lot of other factors, but this zone, one of the factors is the previous move was down. The other factor is what made it go down. What made it go down is the bond market selling off. So interest rate sensitive NASDAQ, because the higher the interest rates go, the worse for the stocks. So if you go back, let's say, to a weekly chart of the NASDAQ, and I'm going to put this on the left. Here's a weekly chart of the NASDAQ. On the right is the long-term bond. You can use the 10-year, but I just use the ZB. That's what I used for 40 years. It's worked great. So when you go to a weekly chart, what are you going to notice? The bond market got trashed last year, and the stock market got trashed. Now, you might say, but the bond market the year before went down and the stock market went up. That's because usually the first leg down of the bond market is because the economy has improved. Yep, after COVID. It's the second leg down that matters. As you see, that's what happened. So the thing is, the reason that this happens is because the higher interest rates go, the more the price to sales and price to earnings of these high flyers contracts. It's all about future cash flows and future earnings. So if bond rates go up, yeah, these are more likely to go down. And that brings me to the next thing. If you see a zone, like we're showing a zone, here's your zone, as you see. And the way I'm looking at this is what's the probability other than the resistance and the prior move? If NASDAQ stocks are more likely to go down if the bond market's selling off or interest rate rallies, then when the bond market's on its low for the day, this is more likely to break down, not up. So if this was over here and you say, well, or me, it's a bear flag, it's at resistance, but the bond market's up a point, heck yeah, I'm not going to mess around with this. All about probabilities. So that's one way to play a zone. So that's ultra short term playing a zone. Now, the other thing, and a lot of people know, I like to play like Stewie patterns. So what's a Stewie pattern? And this I'm going to show you on the QQQ. A Stewie pattern is like a W pattern, like an inverse head and shoulders. The reason I call it Stewie is because when I highlight it, it sort of looks like Stewie from Family Guy. But this is also a zone. So right here. So that zone is formed by that inverse head and shoulders. Now you might say, well, that's a little ambitious. Why not do it from here? Sort of like in that zone, a little W right there. Yeah, you could do that. But the point is that once it forms a W pattern, once you do a W pattern, that's a zone also. The problem is, like I said, it's probability. And the lower the bond market goes on the upper left, the less probable it is that this whole channel or zone will break up. You got to see everything at a tailwind. And I don't think you have it right now. Now, tomorrow's the CPI report. So it's possible that this bonds has a miraculous recovery. But at the moment, as you see this, you're seeing what I see, that you don't know yet. Yeah, it looks like it's in some kind of zone, but it sure hasn't worked well. So now why haven't the bonds gone up to here? Why hasn't the bond market gone up and had more of a rally? Well, probably because bonds hate inflation. So I'll give you all the steps. So the first step is the bond market chart. The second is to look at something like the Dow Jones Commodity Index. As you see, this has had a heck of a rally in 10 days. So if that has a rally, then the bond market's less likely to rally, which means that any kind of zones that you have that look like consolidations to the downside are more likely to work to the downside. So now you have 5 things to look at: MACD, ATR trailing stop, support and resistance, the most lines you can draw, the bond market, and the commodity indexes. And that'll get you a long way, long way. So let's go into some of the other ones that I've seen with zones. So I showed you an ultra short-term chart in Broadcom. So what other ones can you do? Well, you can go into this. Star Bulk. Oh, where's that zone? Well, it's opposite of Broadcom. So I'll put it on 2 different time frames so you could see it. So this is what I'm watching. A lot of times you see a stock do this, where it sells off, looks like a bear flag, But really, this is another thing from my chart pattern. It's all about probability. A bear flag against huge support is most likely not going to go down. So that's a lot different. Look at this chart on a daily chart. Look at this sort of breakout, even though it's a little sloppy. And look on how it stopped right in the support zone. So there's your zone. So you had this zone. Just take the tops and the bottoms. So you had that zone, which it came back and tested a lot of times. Then you had this sell-off, which stopped at those zone areas. So look at this on the left and all this support. And then on the right, look at Broadcom. Now, don't get me wrong, whole market might go nuts. I don't think it is today because the bond market's on its low. So the more probability trade is the NASDAQ's going to have another leg down. That's why I gave you all these steps. So I gave you the indicators. The Dow Jones Commodity Index moves the bonds, and the bonds move the NASDAQ. So those are sort of the steps. But getting back to it, here is Broadcom on the right, 15-minute chart. I think you see the lack of support on the way down. So this bear flag is more likely to work. Look at Starbulk on a daily chart on the left. That's a shipping company. So look at all that support. So this has no support. This has a ton of support. So guess what? Don't laugh. We can draw another channel. So you have this channel on the left, right in this zone. It's not a perfect zone, but it has a lot of schmutz in that area. Now on the right, I'm going to put Starbulk again and put it on an hourly chart. And there's your channel the other way on the upside. Right in there. So there's your channel that you can see a mile away. You could see that channel here. I could call it a channel or a zone. And then this zone here. Now, how's the ideal way to play it? The ideal way to play it is to see any kind of overbought worked off well. So what's an overbought worked off well mean? An overbought worked off well is when it gets overbought, it gets to top of the zone, and then it goes back to the zero line and forms like a bull flag. So now if that breaks up, then it's going to break the bigger pattern. That's a beautiful thing. Now, the problem with this stock, it's not that big a move. And when I see the bond market get trashed, I get real nervous being in this overnight, especially with a big old government report coming out. So big old government report definitely gets me to lighten up. So you got the CPI tomorrow, which then brings up this again. So you got the Dow Jones Commodity Index going up. As you see, nice move up. You have the bond market with a nice move down. And now you're like, does it really matter what the CPI says? Because that's a lagging indicator. Shouldn't the Fed worry more about that Dow Jones Commodity Index? And that's how I look at it. So if this breaks, let's say that the report tomorrow is really hot, the CPI, and this gets trashed down to here, all the way to there, then you got to think the move in the NASDAQ is going to fail a breakup. So that's how I'm looking at this. So that's why I try to do probabilities. When I see Starbulk look pretty good, looks fine, looks pretty good, but I see this bond market down that much, well, heck, do I really want to go home long this, even though it looks pretty good? Do I want to go home long when if the bond market goes any lower, they're going to toast the overall market? So that's why I got to be real careful. If this NASDAQ was down 74, but this bond market was breaking up, darn right I'd stay in more of this. So I got to also determine overall market perspective. So I just can't stress that enough. In fact, but that's what I'm doing. So I'm actually staring at a different screen in here. But that's what I'm doing. Let me see if I can move this. No, that's fine. Just kind of have to deal with me looking to my left. But this is a better screen and better resolution. So where are other channels? How do you find them? Well, every bull and bear flag, believe it or not, is a zone. So a lot of times what you could do is let's take an hourly scan, just an hourly scan. And you could go and actually do an hourly squeeze. Now, every squeeze isn't a zone, but most zones are a contraction volatility. So I took all stocks, 500,000 volume. All of these things are perfect, are personal preference. I did a squeeze on an hourly chart, and that's all I'm doing. Just as simplistic as I can. Stocks over 30, at least 500,000 volume, and a squeeze on an hourly. And then I scan 74 stocks. That's not that bad. Guess what number one is? The most expensive. Yep, Broadcom. Isn't that wild? Yep, it has a tight consolidation on an hourly chart. You could take Netflix, but all of these that spit out, all this is squeeze is readily available on Thinkorswim. And then this is personal preference. All stocks, all optionable, over 30, 500,000 volume. And then what I do is I determine zones with all of these stocks. And you'll find some good ones. Now, keep in mind with a CPI coming out, I'm not going to stick my neck out overnight when the bond market's already on its low. But let's say the bond market broke up. So let's just say it broke up. So these bonds, instead of looking like dirt, completely go up to here. Well, then I'd change this. If you start seeing, let's say, GME and AMC and a lot of that schlock stuff go up, then I'm going to look for channels on smaller stocks. So I would change this instead of bigger stocks. I'd be doing this. I'd probably go from 5 to 30. Problem with that is it's extremely difficult to do swing trades on the upside, let's say over a period of days or weeks, when the overall bond market that brought down the overall markets is acting lousy. But if it wasn't and the bonds were up, I'd be doing a cheaper scan to find channels on cheaper stocks. So when you go down to these, that was the more expensive. You have FedEx on there, you have Netflix. So these are hourly. So let's go put Netflix up here. See if we could determine something. Oh, that's the other thing. Does that look like Broadcom? It doesn't really have a bear flag like Broadcom, but it is some kind of zone. When I see this kind of candle, then I'm much less likely to look for a breakout on the upside. So if I'm long, these big red candles usually mean it's going to go down, not up, because it already had the reversal candle, that big old red candle. Now, that's not always true. I took a loss in this, had great news, and guess what? It got nailed. Got nailed on this move right there. That big red candle, and guess what? It came all the way back. That is not normal. So I got out in here, unfortunately, but it didn't have my criteria of staying in long. This had good news here and went straight down. And keep in mind, the NASDAQ didn't go down. It's not like the NASDAQ pulled this down. It just, the speculation on these smaller stocks just isn't here at the moment. So that's why, even though it had a channel or a zone, and we were patting ourselves on the back where pre-market it was trading at 9, it got back under the zone. So I just took this off my screen. I'll find better ones. But those are the kind of zones. You can find them on weekly. Let's take... Here, let's take something on a weekly. It's forming like an inverse head and shoulders. That's just slop right there. What the heck? On the other hand, look at this zone down here. Yep, there's your zone. And yep, the bond market had rallied. And guess what? This was more likely to break up than down. So it's all about probability of which way it's going to break. And so I'm just looking for more of them for you. But this was more likely to break. But guess what? I can't tell you how many times that I've seen this break up and then get overbought, and it does a back test of that breakout. That's your key right there. When you see the back test, then shorter term, you're looking for a positive reversal signal. So just take that day in 2020, 316, right in here. 316. So when you see it back test right there at 316, you're then going to a shorter term chart and you're trying to find a reversal pattern. We can do it on a daily. That's why a lot of times I say you always get another chance, because when you break out, a lot of times you get that snapback. So let's go back to daily and see if you see the reversal candle clear. Clearly. Let's see how far back I can go. Now, I can't go all the way back. So let me see, because I want to show you this. I think it's a big deal. So we're going to take daily here. I'm going to edit it and make it 5 years. There. And now what you're going to do is look for this. There you go. So, yep, you got that rally about January 20th. So you go back here, rally. Then you got a back test of that line. And look at that candle. What a beautiful reversal candle. That's what you're looking for. The problem is that was a 5-point move to the upside. So everybody thinks that, oh, I missed it. I missed it. But really, that's what you're looking for, a reversal candle. You're not going to pick the bottom, because that's real easy to say, yeah, that was the bottom I should have bought. But on the way down, yeah, that's why you don't buy on the way down. You wait for that reversal candle. I can't tell you how many reversal candles I see on the bottom or the top. So it's pretty impressive to see something with a big old wick. And that's what you're looking for. So you got that back test here of that zone, and then you look for that reversal pattern. And that's what I'm looking for. So that kind of thing. And you'll see it. You can see it intraday. You'll see like a, 5-point move. And that to me means the end of the down move. When you get that kind of wick, even on a weekly, right where I have the arrow, it stands out even on a weekly, that wick. Just like here, you had the wick to the downside. And that put the kibosh for a long time on the stock. So months. There's a wick. Yeah, for months. And then you had, believe it or not, you had wicks here. And that was the top. Then you had the wicks the opposite way. So I'm just telling you, when you get into some kind of zone, a lot of times it creates an overbought on the first rally above it. And then you have to see what the overbought sell-off is. So if I see this and I see it go up, so I see it break a channel and I see it get too overbought, What I mean by working off the overbought well is that it stays above the channel like it did on a weekly here. And then it gets back to the zero line. And then you go to a shorter term chart to find your initiation. So I hope that helps on what I'm showing you in there about zones. So I go to indicators, just a few, oscillators, and don't get me wrong, a lot of the indicators I'm not showing can work too. A lot of them that are widely available on our site can definitely help. But indicators, oscillator, ATR trailing stop, and then you look at the overall market perspective. Right now, the overall market perspective is these refuse to go lower when the bonds were down 16. So yeah, they'll probably rally, which is what happened. So I hope that makes sense to everybody. Thanks for listening. I love doing these kind of zones. That's what I look for all day. So take care.